Hey everyone, it's Daniel here from InfoRest. Hope you're all doing well. Want to quickly talk about the markets here. We're seeing oil prices basically plunge to new lows around $71 per barrel. We're seeing equities trading kind of in limbo. It's been selling off the past couple of days, especially because we've got PPI inflation data coming out Friday and CPI data coming out next week as well. We'll probably see more of a bigger move once those data points come out. And on top of that, we've got FOMC meeting coming out next week as well. And definitely there will be big movements in the equity and the bond market as well. When we look at the bond market, we see bonds kind of pushing up in higher prices where the yields are dropping, and more of the longer dated bonds seeing their yields come off quite a bit, and aggressive buying in that area, and which basically causes the yield curve to invert even more. So, what is this? What are the signs that we can infer and get when we read the markets and the movements like this, especially when you're getting news, and especially oil, right? Especially oil, and when you're getting news where China is looking to reopen, and a lot of people, argued that this reopening would cause oil prices to spike. However, not really. When I look at the charts here on oil, oil is around $72 per barrel, and it continues to sell off, especially after a couple of days of very positive news from China about the reopening. And one would think, okay, China's reopening, demand is going to come back into the oil market, which means that oil prices should move up. And a lot of people said that, oil prices will move up once China reopens. But we're getting the opposite effect. We're seeing oil prices come down. We're seeing bond prices move up. We're seeing stocks just in the last couple of days sell off. I know, stocks did go up after last November's CPI report. Can stocks continue to move up? Sure. We'll have to wait and see when the next CPI, the next inflation data comes out, and also when Jerome Powell comes out and he comes out to speak. But most likely, we'll probably see a big move after the CPI report, which will probably dictate how the FOMC meeting will be. Now, it's very important to continue to monitor oil, because oil is signaling recession fears. Oil is signaling demand fears, demand collapse. I did a video previously about US manufacturing seeing their orders basically drop, and Chinese manufacturing companies basically see their business with the US completely collapse, seeing this demand collapse, which is bringing weakness for a lot of the Chinese manufacturing business. And that right there is an early sign, early signal. Oil prices coming down regardless of the positive news that is coming out with the Chinese reopening. On top of that, you hear price cuts that the EU is expected to do in Russia, talking about cutting oil production as well, which are all positive for oil, but yet again, oil prices are dropping. So the biggest thing that I would say is, by watching this price movement, the markets are telling you that they're worried for what is to come in 2023, and the oil market especially looks like it's starting to price in this recession, this fear, this demand collapse, which would cause, in a recession, oil prices to really plunge. If you look back in 2008 and 2000, we did see oil prices completely collapse, especially in 2020 during that time as well. Oil prices completely collapse, and we see prices collapse because of this demand collapse, right? This demand shrinkage. So if this is what we're seeing in oil, if this is true, that the traders, the hedge funds, the market participants in the oil market are fearful of what's to come in 2023, oil is your signal. And on top of that, to add more proof to all of this, is that you've got your bonds deviating from the correlation with stocks, where this whole year stocks and bonds were underperforming and they were selling off because of higher rates. Now we're seeing themes of pivot, themes of slowdown, which is bringing up bond prices higher and those yields down. And yes, equities did also rally after that November CPI report, but we're seeing it kind of in limbo, kind of seeing it trade sideways, and it's waiting for the next data, it's waiting for the next report. But just because this pivot comes in or this rate cut comes in doesn't mean that the recession is over, doesn't mean that this trade is over. We can definitely see the divergence between stocks and bonds, where this whole year they were moving down together, but maybe in 2023 we could see that stocks will continue to be under pressure in 2023 while bonds reverse, especially on recession fears, especially on this pivot stance and so on. On top of that, Bank of Canada also came out today and hiked rates by 50 basis points. So rates are about 4.25%, and the markets are expecting that the Bank of Canada is probably going to pause here. So this might be the real pivot, but again, anything can change if new data comes in, if oil all of a sudden decides to spike, what have you, right? Bank of Canada can come out next year and go with 25 basis point rate hike and continue to raise rates more and more. So the expectation is that we could see this pause or this 25 basis point rate hike from Bank of Canada, which is your first signal, which could be your first pivot, a first central bank to pivot, which may signal towards the other central banks around the world, like the US and so on, right? But at the end of the day, we will know more as we continue to monitor the data, as we continue to monitor the growth information, as we continue to monitor inflation and continue to monitor these geopolitical risks, the news out there, and most importantly, commodities like oil. So let me know what you guys think. Leave a comment below, hit the subscribe button, like button, and the bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.